I can almost guarantee you have not heard about this because I had a hard time finding anything in the news about this, but this news is one you need to pay attention to because we're talking about Germany's largest lender. Matter of fact, what you probably don't know is that Deutsche Bank just had a massive drop in their stock price. How big? 92% over the corresponding year. Yeah, that big. You know, it's not about Deutsche Bank because you're like, oh, that's Germany, this is the US. What does that have to do with us? Everything's interconnected, especially the banking industry. This isn't just one bank's problem. This is literally a full-blown banking crisis just beginning. That's what this is. But you know, when you ask Deutsche Bank, why did you guys drop 92%? What happened? Well, they come back and they tell you, oh, we've been dealing with this Ponzi scheme for this lending thing, and it's cost us $329 million plus rising litigation costs. Hold on a second. Just so you all know, $329 million, it's a lot of money, but to a giant conglomerate like Deutsche Bank, it's a drop in the bucket. That's just the surface foam. You're not seeing the rest of the problem. Because not long ago, Deutsche Bank said they were gonna lay off 16,000 people. Now they abandoned that, but that's of 90,000 employees that they have. Now they're talking about it again. So what we're gonna dive into today is we're gonna dive into what's going on with Deutsche Bank. How can a bank of that size drop 92%? Well, if you're even thinking that, you forgot about Lehman Brothers back in 2007 because that bank was definitely too big to fail. But they certainly did, and you're starting to see what I've been talking about so often. What is the domino that's gonna go down first? This might be it. We're gonna dive into it. My name's Chris Naugle. This is What Now? What's next? The banking industry. But here's the real problem. Again, like I said, it's not just Deutsche Bank and their 92% fall. It's that Deutsche Bank is a part of a much bigger, global, interconnected banking system. That's the problem. We saw this back in 2003. Now, you probably didn't hear about that either with Credit Suisse, but in this article right here, you can see this was also a problem then, but it was kind of glazed over. Is it going to glaze over again? I don't know. But the thing I'm trying to point out is the problem isn't just the bank. The problem is the entire economy, the German economy. Check this out right here. Germany's economy has contracted for 2 straight years in a row. And you've probably heard all this stuff about Germany and the EU and all the issues they're having. They are having massive issues. Matter of fact, they dropped interest rates. They didn't hold them like the US. But hold on, I'm getting ahead of myself. Let's go back to Deutsche Bank. You know, in all this crap going on with Deutsche Bank, and just put yourself in the driver's seat. Let's just say you were the one who was running Deutsche Bank, and your company, your stock just fell 92%. And you're talking about why? Well, they made it very clear, according to this article, that they are staying very committed and standing firmly behind the DEI. I'm sorry. I'm not saying there's anything wrong with DEI or anything right with DEI. I'm taking a neutral stance there. But if your company had just fallen 92%, would that be what you'd be putting in the news?
We are firmly behind our DEI initiatives because they have proved to be very, very positive for our bank.
You. Let's talk about why your bank is failing and why your bank could be the first bank that goes down and sets off the entire collapse of the banking system. That might be what people would want to hear, not about your DEI nonsense. I did find this article, which I think you'll be really interested in right here. Germany's GDP, and it talks about how it sank 2% in Q4 of 2024. But it's not just Germany. France has got the same kind of crap going on. Check this article out with France. Their entire economy is also contracting. But hold on a second, there's a bigger picture here, bigger than Germany and France. Why don't we look at the entire European Central Bank, the ECB? Well, they were forced to cut interest rates. Yeah, they didn't just do it because, hey guys, you want to cut interest rates? Nope, they were forced to because they have come out and admitted our economy is slipping, and it ain't just a little. But I'd be remiss not to talk a little bit about the United States of America and Donald Trump and his administration, because recently, just this past weekend, they placed tariffs on Canada, Mexico, and a duty on China. The EU's got to be sitting back just saying, oh my God, what's in it for us? What's going to happen next? But if we can learn anything from the past, the real problem about this European mess that's happening right now is not Europe at all. It's that Europe is a part of all of it. Okay, Europe is a massive part of the global banking system and just the world economy. So if something happens in Europe, it's going to be felt in the US. If something happens in the US, it's going to be felt in the rest of the world. So as you can see, this entire thing has global repercussions, more so than anything else when it comes to liquidity, because that's where we're seeing the problem right now. It's not a problem of anything else. Listen, if we could just keep printing money, we don't really have a liquidity problem. We have a debt problem, which then, I don't even know where that lands. But right now, liquidity, which is what brought us down in 2007 and 8, that's what we need to focus on. So let's roll tape and go into the US economy. And well, I mean, we got to be doing great here, right? Because if you're watching the news, the stock market's at all-time highs, everything looks great. Yeah, well, everything looked great right before the Great Depression, right before the Great Recession, right before the pandemic. Everything was booming like it is now. So right now, the US economy looks good on paper until you flip the paper over and you start seeing the real cracks in the foundation. You know, it's kind of like when you buy a house and it's got one of those indoor-outdoor rugs in it, and you're like, oh, this looks nice. Until you peel the indoor-outdoor rug up, and then all of a sudden you're like, holy crap, it's all cracked and falling apart. Yeah, that's what I'm talking about. That's what you're not seeing. You see, the carpet looks great. Matter of fact, they just had it steam cleaned, so it even has a nice smell to it. But underneath that beautiful steam cleaned carpet are a whole bunch of deep foundational cracks. Oh, and then you find the termites next. But anyway, let's go into Q4's GDP. So how are we doing here in the US? Well, it slowed to 2.3. Now, do you know what that means? Do you have anything to reference that? No. So let me give you something. So it was down from 3.1. So we went from 3.1 in Q3 to now 2.3. Anyone see the problem? First crack in the foundation. But let's keep going. Consumer spending increased by a whole bunch, 4.2%. Consumer spending. Gosh, that must mean the economy is booming. Or, if you've been watching my videos, that actually just means that consumer debt is through the roof right now. Yes, they're spending more, but they're doing it with debt because the savings that they had during the pandemic and after the pandemic, that is dried up. And we are literally just building on this massive debt bubble, which eventually someone's gonna come along and be like, that's a really cool bubble with a pin. And they're gonna, but to continue with the foundational cracks, now we're gonna get into those little termites, and those little termites are private investors. Yep, private investment has plummeted by 5.6%. You can see it right here. That means businesses are preparing for a recession. You know, not long ago, or maybe it was a long time ago, I talked about a study that was done where they looked at all the CEOs of big companies, and all the CEOs were predicting the US was going to be in a recession in 2025. But you know who was not predicting that? Yeah, the economists that work for the government and everybody else. But the business owners who are frontline, who see it coming, yeah, they are battening up the hatches, getting their house in order, getting their business in order, stockpiling cash, just like I've been saying you should be doing. So how can the market keep going up when businesses are not putting money in? Because that number is not a lie, that is factual. Yep, collapsed by 5.6%. So where is all this money coming from? Well, I've said this before, and you should probably know this. The United States of America is the nicest house in a really shitty neighborhood called the world. That's right. So if you are in another country, like if you're in Europe, Germany, or maybe anywhere else, you're looking at the US being like, ooh, look at that investment opportunity. All the money that's flowing into the markets here in the United States, much of it is foreign investments. Why? Well, because we're the nicest house. The rest of the houses are shambles, meaning countries. So that's where the money's coming from. But when will that money stop flowing in? Well, when all of their economies start going in the tank and there is no more money, hence the liquidity crisis that we are staring down the barrel at. But the final thing I'm going to talk about are exports. Exports are usually a really good measure of how are we doing Well, exports are down 8%. We are literally looking at global demand diminishing. That's right, because that's exactly what that means. So what you're looking at here is a pattern that is very similar to another one that I lived through as an advisor, and that was 2007. You see, GDP was just fine until it wasn't. And that's when it all collapsed. So what you're looking at now, although it looks fine depending on what you're looking at, it is one thing away from a complete collapse. But we're not gonna collapse completely. And before we collapse, I'd love to ask you to do me a solid and click that subscribe button. And also there's a little bell right up top. What I'd like you to do is smash that bell. Damn, frickin', hang on a second. Is that all right? My computer just went out. There we go, all right. Smash that bell so you're notified every time I put a new video out or when I go live. But let's get back into this because now we're really into the juicy stuff. I want to kind of go into the stock market because I know so many of you are looking at the stock market, you're looking at your 401ks and you're like, yes, it's doing good, it's gonna go to the moon. Well, what if I told you it's not? And I'm gonna just read right off of here because these are some economic warnings that are being put out that you're not gonna see in the news. But here we go. The stock market is soaring, and some would argue that the Dow Jones can hit $100,000 in the next year. Yeah, that's 2025. How many of you would be psyched if the Dow Jones went to 100,000? But they're saying that, and they're saying that if it went to 100,000, the only place it's going is back down. Now, let me give you some of these right here. The Buffett indicator, which is the market cap to GDP ratio, I know, fancy stuff, is at 194%. Now, that means that stocks are more overvalued than they were during the dot-com bubble. And if you know anything about the dot-com bubble, man, shit was frothy back then. Woohoo! All right, so the Shiller PE ratio, now you should definitely know what this one is. This is the measure of stock valuations. It is right now at 38.1. Now, pay attention, pay very close attention. 38.1 is where we're at now. Almost where the 1999 levels were. See, more of that dot-com stuff coming in. But this is the one that really alarmed me. I should put my glasses on because I want to make sure I read this exactly how it's written. The total US stock market capitalization is $62 trillion. Now, let me pause. That doesn't mean anything to any of you. You're just like, all right, cool, Chris says it's $62 trillion, so it's $62 trillion. But hold on a second. Now I'm going to give you something to really think about. The entire US money supply is only 21 trillion. Just think about that. Stock market capitalization is $62 trillion. The US money supply, all the money in the US is $21 trillion. You see what I'm trying to tell you? That means that the stock market is solely being held up by that foreign money that I talked about a little bit ago, but more specifically, FOMO. The fear of missing out, speculation, oh, it's going to the moon. The same thing that happened right before the Great Depression hit. Study it, because I have, and that is the exact same thing that happened. God, I'm like getting chills thinking about this. It's framing up, it's setting up just like it did back then. But this is different this time, right? Oh, the Fed's gonna step in and print, and they're gonna do fine, and Trump's gonna make the economy great, and these tariffs they're just gonna be a temporary little thing. Couple months of increased prices, then we're all good. Wrong. Probably more like a year or 2 years is what you can look at if you decide to go back and study history. Tariffs will be good for the United States of America, but they will have a lot of pain. And you know what? There was something that was sent to me, and it was something Elon Musk said, and it was basically just him kind of articulating what has to be done in order for the U.S. to be great again, for the U.S. to be what it was in its heyday. And you know what that meant? It's got to fall apart first. Things have to completely collapse in a roundabout way in order to get where we need to be. The swamp, the proverbial swamp, has to be drained. I don't know if I'm saying that the right way, but essentially what he said, and if I can find it, I'll put it up on here for you, but what he said is exactly what is happening, because that's the plan. but it ain't gonna feel good. Your 401ks aren't gonna feel good. Your investments aren't gonna feel good. Things aren't gonna be going to the moon. They're gonna be going, down to that place, yep, before they rebound back up. And if you're not ready for it, I don't know what to tell you. If you've been following my channel because you subscribed and clicked that little bell, you know this is what I've been saying, probably for far too long, but you know what? You can't time the market. All you can do is get prepared, get the house in order, and get your money out. Take your profits. Hell, if you're good, short the market. Now would be a good time. Markets are hemorrhaging today because Trump said he was going to put tariffs on. Trump has been talking about putting tariffs on these countries before he was even elected. And now, just this weekend, those tariffs were put in force. And now all of a sudden everybody's up in arms. They're like, oh my God, I can't believe it. And the markets are shedding off a bunch. Like, where were you guys 6 months ago? Were you not watching and listening and paying attention? Do you think it was a bluff? Did you think he wasn't gonna do it? Matter of fact, the duty he put on China is like nothing compared to what he said he was gonna do. So there's more to come. And what's next for Europe? Well, we'll have to wait and see, won't we? It's like that end of the movie that you're just like, oh, come on, just get to the end. I think I know what's gonna happen, and then the complete opposite happens. Anyway, the stock market isn't rising because the economy is strong. The stock market is rising because there's no alternative for foreign investments. There's just no other place for them to put their money. That is it. Is that conclusive enough for you to keep your money in? Because it isn't for me. There's two more things I wanna hit on. Number one is I want to hit on the banking system. And I want to tell you and show you how the banking system right now is a house of cards. It's a liquidity crisis in the making. Now, how can I prove that? Well, right here, Deutsche Bank, what I started with. Right now, their troubles signal that the big banks, because Deutsche Bank's a huge bank, the big banks are struggling to access liquidity, which should be no surprise. The Fed has literally come out and said, hey, when they were raising interest rates, they said, hey, we're also going to suck money out. We're going to unwind our balance sheet, which literally when they unwind the balance sheet, which they did, and I think still continue to, what does that do? Dries up liquidity. Not so simple, folks, but the entire banking system is so interconnected that just one bank, like Deutsche Bank, could send the whole thing a-tumbling. Now, some of you are like, well, yeah, but what happened when Silicon Valley Bank went down and Republic and all those other banks? Those were like small regional community banks. They were just like a little grain of sand in the entire banking system. Now, yes, it made headline news because it showed some material problems, but we're talking about Deutsche Bank. We're talking about the behemoths. These are the ones that do move the market. So is this just the start of the domino effect? I don't know. But it certainly is a good thing to pay attention to. But let's go on to the US dollar. I mean, come on, we're the United States of America. But because we hold the almighty dollar, and the almighty dollar is doing so well, it's literally creating a global liquidity crisis. I mean, think about it. The US dollar is so strong against other currencies right now that other currencies, they can't buy the goods and services from us that they need. So therefore, it's creating this problem. And let's talk about that problem. I got some stats here for you. The Colombian peso. I know, what do you care about the Colombian peso? Well, it devalued from 1,800 per USD in 2014 to 4,100 per USD in 2024. The Brazilian real, the Japanese yen, the Canadian dollar have all suffered major losses. I mean, that Trudeau joker up there in Canada, yeah, he's a little bit worried right now what's going on. But other news is China. China's real estate market collapsed by 30%. It wiped out $20 trillion in value. But the US dollar, we got the dollar, right? It's the almighty. Yeah, until it's not. That's the real concern. So to wrap this all up with a little bow tie, the global investors that are pouring money into the US economy, the US markets, it's because there's no better place for their money to go. And that will continue, and that will keep our stocks high, that will keep our bonds stable, and that will keep our real estate market propped up just like it is now. Until it's not. Until you have one event that trickles down and rolls right straight through the entire global economy. And then, well, then we're going to be in a major recession. But the real question you all want me to tell you, which I can't, is when? I don't know. Is it second quarter 2025? Is it third, fourth quarter 2025? Or is it 2026? I have no idea. I can't tell you when because you can't time the market. Not even the best in the world, Ray Dalio, can do that. And he will tell you point blank, you can't time the market. I almost lost my entire company trying to do that. So what do? That's probably the thing. Chris, this is all good and great, but what do I do? Well, I would start with taking your winners, okay? You got to know when to hold them and got to know when to fold them. And now is the time to take the gains off the table. I don't care if it's in your 401k, your investment account. I don't care what your financial advisor says. Why don't you ask your financial advisor to go in and explain about the global liquidity crisis that's unfolding? He won't have the slightest clue because he's just sitting back playing golf or not doing a whole heck of a lot of anything except for collecting fees every single month from you. Now, how do I know this? That's what I did. And your advisor will only react when everything's falling apart, when you call them. That's right. And then it will be too late. And then you will hear things like, well, it's just a paper loss. Oh, you're going to have to ride it out. Oh, we're in this for the long haul. You got to invest for the long haul. Nobody's ever lost money over a long period of time. Yeah, how much time do you actually have, folks? How much time do you have? You got enough? You got 20 years? You got 30 years? You got enough time? Because if you went through 2008, it took you over a decade just to get back what you lost. Not to get ahead, just to get back what you lost. You got that much time to give up? Do you want to give that up? Do you want to give that up just because you can say, oh, I'm a long-term investor. I'm just going to hold through this. I'll be fine. You won't be fine because emotions will kick in. Your fear gauge will kick in. I've seen it. I know it. And you know what? I'm not the only one. You will sell and I will buy. But I will buy when you've lost a lot, and I will not laugh because it is not fun to laugh at somebody else's misfortune. But your misfortune doesn't have to be a misfortune. You could just get ahead of this thing. You could literally just start to prepare and sit on the sidelines. This is like so much different than the other times too, because right now the sidelines are actually paying you. That's right, you could sit in high yield savings accounts, still making 3-4%. You could sit in very, very conservative T-bills and treasuries, and yeah, you're still making 3-4% there. Heck, you could take your money and put it in specially designed and engineered whole life insurance. Yeah, most of the whole life insurance companies that we deal with are paying between 5.75 and 6.4% dividend crediting rate. Oh, and that's tax-free if you design them right. So, I mean, there's lots of options for you. But none of it's going to matter if you don't get your head around this. If you don't get your mindset wrapped around something nasty is about to happen. It is. Are you ready? Or are you just going to say, I'm just going to get out now? Because like, hey, I see it. Chris, I get you. I understand what you're saying. And I think just sitting on the sidelines, listen, during 2008, let me just ask you this, 2008, 9, 10, 11, 12, 13, 14, do you know that investors would have probably jumped off a bridge to make 4 or 5% on their money? Did you realize that? They would have been thrilled. In 2008 and 9, in the height of the Great Recession, people would have been like, I would give anything to just make 4%. And now you can make 4% in your freaking savings account, and yet you're still in the market taking all this risk because you think the stock market's going to repeat what it did in 2023 and 2024. You are living a delusion. You are literally not understanding the severity of this situation. And if I could just kind of do a quick recap for you and just point out some of the severities that we're talking about. Literally, we're looking down the barrel of a global recession. This won't just be the EU. This won't just be China. This won't just be other countries that you don't care about. This will be a global recession. And the US right now is mirroring 2007. It's also looking a lot like 1999, right before the dot-com crash kicked in. It's got a lot of similarities. China is in a deflationary crisis right now. They've got a aging population and they cannot support the growth that they need to because they just don't have the workers. They don't have the workforce because back a long time ago they said, hey, one kid, just one kid, and we're gonna punish you if you have any more. You know what? Best advice I can give you for the United States of America, go make babies. Go make babies because you will make a better world for your kids. But they gotta start having some kids. That's all I'm saying. So I don't know, there's all sorts of really good ways to do that. I mean, maybe some Red Bull, I don't know. Does that help you? Whatever it takes, just get the job done. pop some babies out. Anyway, back into it. The banking system is showing some severe cracks. We have been looking at these cracks since Silicon Valley Bank, now Deutsche Bank, and this won't be the last time you hear me report on this. The stock market is so overvalued that Warren Buffett won't even touch it. He's sitting on hordes and hordes of cash, but yet you're still putting money in the markets? Who's better at this? Warren Buffett and his team of guys and gals, or you? Warren Buffett, you. I think my point comes in pretty strong there. So when it comes, most people are going to be completely unprepared, but you are not most people. If you're watching this right now, you are part of the 5%. Hell, you might even be part of the 1%. So definitely get your house in order, get your family in order, because there is not going to be any mercy for those that are unprepared. I'm telling you, the banking system, the inflation, everything that's coming, everything we're seeing today, it's going to run everybody over that is not ready. And it might run us over even if we're ready. So I don't know, but you know what? I'm going to take the high road. You decide where you want to be. With that being said, thanks for joining me today. Hey, if you liked this video, check this one out right here, 2025. I did that video a while ago. Don't know how true it is, but history will prove. Thanks for joining me. My name's Chris Naugle. This has been another episode of What Now? What's next for you?